The corporate graveyard is littered with titans who dismissed early disruption as inconsequential noise. Consider the financial autopsy of Blockbuster, a company that once defined home entertainment, yet failed to grasp the seismic shift Netflix represented, fundamentally miscalculating its long-term market viability. We examined the exact financial variables that led to Blockbuster's $50 million Netflix fail, a boardroom decision that accelerated its eventual multi-billion-dollar collapse. This catastrophic oversight, a refusal to acquire an agile competitor for a sum less than a single year's advertising budget, provides critical lessons for navigating today's volatile market contractions and sector repricings. Just as companies now grapple with AI-driven obsolescence or sudden supply chain reconfigurations, Blockbuster faced an existential threat that they categorized as a niche market anomaly. $9 billion in annual revenue, with a reported enterprise value exceeding $5 billion. By 2010, the company filed for Chapter 11 bankruptcy. Its enterprise value plummeted to effectively zero, burdened by an estimated $900 million in debt and negative cash reserves. The transition from physical media to streaming was not a gradual evolution but a sudden, violent disruption of established unit economics, analogous to how today's private credit squeeze is repricing entire sectors overnight. Blockbuster's leadership viewed their physical asset-based thousands of retail locations and millions of DVDs as strengths, failing to account for their rapidly diminishing return on invested capital. This critical misjudgment stemmed from an inability to accurately assess the escalating cost of capital, tied to an increasingly obsolete inventory system. The core structural mechanism of Blockbuster's failure lay in its asset-liability mismatch, specifically the fixed costs associated with its vast retail footprint against declining variable revenue streams. Each store represented significant real estate leases, staffing payrolls, and the continuous capital expenditure required for inventory acquisition and maintenance. As consumer preferences shifted towards digital, the average revenue per user for physical rentals plummeted, directly impacting the company's interest coverage ratio and free cash flow. The company's traditional revenue model heavily relied on late fees, which initially provided a substantial and often overlooked profit margin, effectively a high-interest, short-term loan mechanism for consumers. Netflix, by contrast, emerged with a subscription model that eliminated late fees entirely, reducing a key friction point for consumers and simplifying its revenue projections. Blockbuster's operational expenditures were inherently tied to physical presence, including utility costs, security, and complex logistics for inventory rotation across thousands of locations. This contrasted sharply with Netflix's asset-light, scalable digital distribution model, which benefited from near-zero marginal costs per additional subscriber. Blockbuster's average fixed cost per transaction continued to rise as fewer customers frequented stores, while Netflix's average variable cost per transaction approached infinitesimally small figures as its subscriber base scaled. This created an widening profitability chasm that Blockbuster's traditional financial models struggled to comprehend. The structural breakdown was further exacerbated by a lack of liquidity, stemming from Blockbuster's inability to divest its physical assets quickly or redeploy capital into new, viable ventures. The company's cash reserves dwindled, transforming from a healthy surplus in its peak years to a critical deficit, forcing reliance on high-interest debt to maintain operations. This debt service became an unsustainable burn rate as revenue streams contracted, a classic symptom of an enterprise caught between declining asset values and rising operational overhead. The market's shift was not just about convenience. It was a fundamental repricing of media distribution economics, penalizing asset-heavy models with diminishing returns. Blockbuster's entire supply chain, from studio agreements to in-store merchandising, was optimized for a physical paradigm that was rapidly eroding. The definitive boardroom capital misallocation occurred in 2000, when Blockbuster CEO John Antioco famously dismissed an offer to acquire Netflix for a mere $50 million. This decision, documented by numerous financial journalists and industry insiders, stands as a stark testament to executive hubris and strategic myopia. Netflix, at that juncture, was a nascent DVD-by-mail service, operating with significantly lower fixed costs and a nascent but disruptive distribution strategy. The Blockbuster board, entrenched in the perceived security of their physical empire, saw no immediate threat from a mail-order startup whose market capitalization was a fractional percentage of their own. Instead of acquiring a direct competitor with an innovative model, Blockbuster opted to double down on its failing strategy, initiating ambitious expansion plans and investing heavily in its own online platform, Blockbuster Online. This capital was deployed into a direct replication strategy rather than an integrative acquisition. 7% of Blockbuster's annual revenue at the time, an almost negligible sum for a strategic acquisition that would have provided a preemptive hedge against market shifts. The opportunity cost of this refusal was immense, not merely in the foregone acquisition but in the wasted capital subsequently poured into competing initiatives. Blockbuster Online launched in 2004, requiring substantial infrastructure investment, marketing spend, and logistical support to manage both physical and digital inventories. The company attempted to mimic Netflix's subscription service but failed to achieve the same operational efficiency or customer acquisition scale. By this point, Netflix had already established a significant market lead, benefiting from network effects and a superior user experience built over several years. Blockbuster's late entry meant higher customer acquisition costs and a fragmented brand identity, diluted between its traditional retail presence and its nascent online offering. Further capital misallocation manifested in Blockbuster's continued investment in its physical store footprint, even as foot traffic visibly declined. Lease agreements, many long-term, became crippling liabilities rather than assets. Instead of strategically closing underperforming stores and reallocating capital to digital innovation, the company continued to sustain an expansive retail network, burning precious cash reserves on depreciating assets. This perpetuated an unsustainable capital structure, directly contributing to the eventual bankruptcy. The total capital expenditure allocated to sustaining and expanding the physical empire, coupled with the failed Blockbuster Online venture, far exceeded the initial $50 million price tag for Netflix. It demonstrated a profound misunderstanding of capital allocation principles, where investment was directed toward shoring up a decaying core business rather than acquiring or developing future-proof growth drivers. This capital was effectively trapped in a declining asset class, unable to generate a positive return on investment as market dynamics shifted against it. Blockbuster's management failed to grasp that the value of their physical assets was rapidly approaching zero, making any further investment a destruction of shareholder value. The strategic error was not a passive misjudgment. It was an active misallocation of capital, redirecting resources from a potentially transformative acquisition into a futile attempt to defend an indefensible business model. This created the precise structural vulnerability that the burgeoning digital distribution market ultimately exploited. The company's leadership was so focused on quarter-over-quarter retail performance that they entirely missed the long-term, systemic threat posed by a fundamentally different capital structure. The balance sheet reflected a company tethered to an outdated paradigm, while the market was already building a new one. In its final stages, Blockbuster's story culminates not in a triumphant restructuring, but in a complete liquidation, a definitive endgame for a business model rendered obsolete. The company officially filed for Chapter 11 bankruptcy in September 2010, burdened by an operational model that could not compete with the low-cost, high-efficiency digital platforms it had once dismissed. Despite attempts at reorganization and a brief acquisition by Dish Network, Blockbuster's core physical rental business was fundamentally broken. Its asset base, once the envy of the entertainment industry, became a liability, unsellable and unsuited for the new economic reality. The business model was not merely destroyed by an unsustainable capital structure in the typical sense of over-leveraged debt. Rather, its core viability was artificial, propped up by a transient market condition that valued scarcity of access and late fee penalties over convenience and accessibility. Once digital distribution eliminated those artificial barriers, the true negative unit economics of physical video rental became starkly apparent. The real estate footprint, the inventory management, and the staffing costs all became prohibitive without the high-margin revenue streams they once supported. The Blockbuster case serves as a chilling economic argument. Some business models are not viable core businesses, destroyed by poor capital structure but rather artificial constructs, whose profitability relies on market inefficiencies that are destined to be disrupted. Their collapse is not a failure of execution but a fundamental repricing of their intrinsic value to zero by market forces. The $50 million Netflix acquisition Blockbuster rejected would have been a negligible investment compared to the hundreds of millions later lost in failed digital initiatives and bankruptcy proceedings. It represents a clear historical marker of how an initially small, almost inconsequential, financial decision can directly precipitate a multi-billion-dollar enterprise collapse. For further forensic analysis of corporate bankruptcies driven by capital misallocation, examine our deep dive into the Enron scandal, where financial engineering masked a structurally unsound business model.